If you're somebody that has late payments, then banks are not going to want to lend to you. And if they do, they're going to charge you a crazy interest rate because you're already showing people that you can't pay back on time. Why would somebody want to lend to somebody that has proven they can't pay others on time? It's annoying. That's high risk. Nobody wants that. Me personally, if I lend you money and you don't pay me back on the time we talked about, then good luck. I'm not lending you money again. Yo, what's going on, guys? I'm going to be showing you guys today the 5 factors that affect your credit. I'm going to be breaking them down, giving you some general information about them. That way you understand how to take care of your credit and leverage it so you can go get access to the bank's money. So let's begin. So we're going to talk about 5 categories today. I'm going to list them in terms of how much they impact you, going all the way to the least impactful. So let's get started. The first one is payment history. This makes up 35% of your credit score. This is one of the most important categories because this tells the bank if you are low risk or high risk. If you're somebody that has late payments, then banks are not going to want to lend to you. And if they do, they're going to charge you a crazy interest rate because you're already showing people that you can't pay back on time. Why would somebody want to lend to somebody that has proven they can't pay others on time? It's annoying. That's high risk. Nobody wants that. Me personally, if I lend you money and you don't pay me back on the time we talked about, then good luck. I'm not lending you money again. Now, obviously, if we talk about it, you tell me what's going on, you give me a heads up, as most banks will, they can work with you in order to avoid putting a late payment on your credit history, but that's a different story. Pretty much pay your bills on time. Payment history has the biggest impact on your credit. If you do not pay your bill on time, then you will get a late payment. It's only after 30 days that you actually get a late payment, which we can break down later. But pay your bills on time, because if you don't, you're literally telling other people that you can't handle money and you're not responsible with it. So you ruin your chances to get approved for funding. So payment history is the top one. The second one is going to be credit utilization. And this is 30% of your score. So credit utilization is basically how much money are you using out of the available credit that you have extended. So to give you guys an example, if I have $1,000 credit card, 10% utilization would be $100. If I have 50% utilization, that would be $500. And if I utilize 100% of it, that's $1,000. That means the bank's giving me access to $1,000. I've used the full 1,000. So for this, you always want to be at less than 10%. And then for late payments, no late payments. Now, some of you guys might have heard when it comes to credit utilization, you are okay to be as high as 30%. Here's the reality. If you go past 30%, it's going to harm you. If you are at 30%, that is usually the higher threshold of what we tell somebody they can be at in order to have a good chance of funding. So if you are holding balances at 30% utilization, you are still in an okay spot, but you'd be in a much better spot by being at that 10% or less. So most people think 30% or lower is good. The reality is you want to be between 0 to 10% at all times. And if you do not have enough money to pay down those cards, then try to get to 30% or lower as fast as you can. So anything higher than 30% is not a good place to be for funding. 30% is still acceptable. And ideally, you want to be at 10% or lower for the best approval odds and the best credit limits. So that's the second category. So the third category is going to be average age of history, or as some people call it, credit age. This is 15%. So this basically tells the banks how much experience do you have handling credit? How long have you had credit for? So this, to be in a good spot, you always want to be at 4 years or higher. Now, unfortunately, this is just one of those things where it just takes time. You can't speed up this process. This is why it's important that you start building your credit as soon as possible. And if you know somebody that is past 18, that is 18 or older, then they're eligible to start building credit today. Tell them that they need to start, because the longer they take to start building credit, the longer it's going to take them to get to that 4-year mark. This is a very good mark to be at. If you're under that, don't worry about it. It just takes time to build it. The minimum we want to be at is at least 2 years. But if you can hit 4 years, that's always going to be preferred. Now, luckily, there's some ways to get around it where you can build credit a little bit quicker. One way is actually by using what's called an authorized user account. Some people call it a trade line. Some others call it piggybacking. Basically, you're telling somebody that has a credit card account that has been open for a long time to add you on as an authorized user. What this does is this allows you to get the data points, which means the history, the credit age, the balances, and the credit limit from that card, and then put into your credit file. And now your credit is going to mix with it and give you a higher age. Now, how is credit age determined? Credit age is determined by adding up all the accounts. This also includes adding loans, installment accounts. So you're going to add up all revolving, which are usually credit lines, and installment, which are usually loans. You're going to add all those up. And let's say you have 10 accounts. Maybe you have 5 credit cards, maybe you have 5 auto loans, right? 10 accounts. Then you're going to divide it by how long each account has been open per month. Once we combine all the months from all these accounts, let's say I have 100 months. This means that I have 10 years of age. That's how you get that number. 10 years of age, incredible, great history. But that's also 100 months. That's close to 10 years. So it makes sense. So this is why it's important for credit age to start as soon as you can. And just understand that anytime you open up a new account, it's going to reduce your credit age. Because now, let's say I open up a new account, instead of being at 10 accounts, I'm now going to be at 11 accounts. And that means I'm going to divide that same number of months, 100 by 11. That might be something like 9 or 8.5 average age. As you can see, the age drops just by opening up a new account. This is why it's important to start building credit young. And also, if you are going to go for funding, to get a lot of stuff at the same time rather than splitting it up. Because if you're always splitting it up, you're always going to be slowly reducing your age. But in the grand scheme of things, it's okay. Because the longer you go without getting credit for it, the more age you're building up. So credit age is 15%. The next thing is going to be credit mix. This is 10%. This is, do you have credit cards and do you have installment accounts? Banks love to see people that can handle revolving accounts and installment accounts. A revolving account is anything that has a credit line. So this can be a credit card, line of credit, mortgage line of credit, a HELOC, home equity line of credit, anything that has an available credit line for you to use and then pay back. That is revolving because it revolves. Then we have installment accounts. Installment accounts, think the word install. They install a monthly payment. They give you one lump sum of cash and then you're always paying it back. Once you finish paying it off, it closes. Installment accounts can be things like mortgages, personal loans, student loans, cash loans, auto loans. So if you are somebody that has a mix, meaning you have installment accounts and revolving accounts in your credit file, they're going to love that. So I always recommend always have both credit cards and some type of loan. And the final category is going to be hard inquiries. This makes up the last 10%. A hard inquiry happens when you ask for credit. Anytime you ask the bank for money, they're going to put a hard inquiry on your credit report. The reason they do this is because this is to alert other lenders that you've been asking for money. If they were not doing this, then nobody would know that you're asking other people for money. And the reason that's a risk is because let's say you asked me for money. If I knew that you just asked 4 other people for money and I'm the 5th person you're coming to, then I might not want to give you money because why are you asking so many people in the first place? And now the way you got to think about it is I'm the 5th person. So that means if times get tough, you're more likely to pay your other people first before you pay me. And the other risk is that if times ever get tough for you, you have 5 people to pay back. That's a lot harder to manage and to fully repay everybody compared to if I was only the one person that you asked. So this is how banks think. The more people you're asking for money, the more likely they're going to deny you. And one rule of thumb is that if you're past 3 inquiries or higher, everything after that is usually going to be a denial. You always want to make sure that you're anywhere from 0 to 3 inquiries max. Now, here I'm going to come on this side. The great thing about hard inquiries is that these delete after 2 years. So let's say it's January 1st, 2025. That means January 1st, 2027, no longer there. So again, hard inquiries, you can't avoid. If you're going to ask for credit, they're always going to give you a hard inquiry. Now, the great thing is there are some banks that actually don't give you a hard inquiry when you ask for credit. And the reason that's good is because now you don't have to worry about this negatively impacting your score. The good thing, though, is that regardless, these will fall off 2 years after. But the plan is to always be in a good spot. So this is another reason why when we go for funding, we go for a lot of it at one time so we can get all the inquiries and then we cool off. We don't apply for anything for 2 years or more. Let that credit age build up. Let that foundation get strong. And then in the future, when we want a bigger amount of funding, then we can get more money. Now, the other thing too is if you have a company that you work with, whether it's a funding company or a credit repair company, a lot of these companies can actually remove some of those hard inquiries. If that hard inquiry is not attached to an open account, meaning you got denied or maybe you got approved, but you decided last minute not to get it, then we can actually delete those. So that's the great thing about hard inquiries. But remember, they're only 10% of your credit score, so they're not going to have such a huge impact. And the other rule of thumb is after 6 months, those inquiries are not harming you as much. So what I would say is if you have a lot of hard inquiries, wait until the most recent hard inquiry is at least 6 months old. That will put you in a better position for funding. If you can, try to delete those hard inquiries either by yourself or the help of a company. And other than that, these are the 5 factors that make up your credit score. So payment history is at the top. Credit utilization is second. We got credit age, credit mix, and Harding Cruise. Be aware of these. That way you can manage them responsibly. And if you know this information, this is how you get one step closer to mastering your credit. So hope this video helped you guys out. Follow this page if you want to learn more about credit and funding, where I'm going to be teaching you guys everything I know. Hope you guys liked it. Talk to you guys later.